Hello, welcome back. Now that you know all about mortgages and how much house you can afford, let's go ahead and look at buying a house. Home ownership is the American dream, and the house is typically the biggest investment for an average American. So as we outlined in the past few videos, the first thing you want to do is to decide on a price range based on your savings that you can afford for down payment and closing costs, as well as your budget. Home purchase or finding a home is very emotional. It's not easy to give up a home that is your dream. However, it's very important that you stay in the price range that you have decided ahead of time, no matter what. And that is why it's really important to decide on a price range before you start house shopping. Once you have decided on your price range and you have evaluated different types of mortgages and compare lenders, it's a good idea to get a pre-approval before you start shopping. Buying a house is a tedious and complex process, involve both finance and legal aspects. So it's a good idea to have a professional to help you. However, you need to remember that real estate agents work for the seller and not the buyer. And the real estate agent can earn anywhere from 3 to 6% of a house value. So selling a house is expensive, but more importantly, the realtor has a strong incentive to make the sale happen. It's important that you shop and compare real estate agent as well as houses. Again, buying a house is very complex and it involves many steps. We're going to go over each of those steps in details in this video. However, a real estate agent can really help, especially if you're a first-time home buyer. Just remember that they work for commission. Even the buyer agent, which is supposed to work for the buyer and not the seller, they still have incentive to get the deal closed so that they can work so that they can get their commission. So just keep that in mind and look for professionalism. We'll talk about some red flags that you may need to watch out for later on in today. So are you ready to find your dream home? In real estate, the most important word is location, location, location. So when you choose a location, you want to take into account important factors in your life. Do you need to how far do you have to commute to work? If you have children, what is the school district like? What about your lifestyle? Do you want to be close to nature, or do you want to be close to nightlife and metropolitan area? So those are important considerations. You don't want to choose the wrong location and having to move soon. Remember, moving is very expensive. Next is the type of housing that you want. The most common type of housing in America is a single-family home. Even for single-family homes, some are part of a homeowners association or HOA. We'll talk a lot more about HOA in a minute, but just keep that in mind. In addition to single-family home, you can also have a multi-unit or multi-family home. It simply means that there is more than one unit in the building. Oftentimes, these combined investments and residence. The homeowner can live in one unit and they can rent out the other unit. Another common type of housing is condominium. Condominium has an important characteristics that you don't own everything that is affiliated with the house. You own part of the house or part of the structure, but the common area and common structure are owned by the condominium association. Once again, we'll talk about that more. Another type of housing that is popular in large cities, particularly New York and Chicago, they are called co-op housing. This is also a common arrangement for manufactured home or trailer homes. So basically, the units in the building or the complex or the park, they are owned by a nonprofit organization. Technically, you're not really buying the unit, but you buy shares into the nonprofit. So you're part of the co-op. So you own shares. What makes co-op interesting is that buying and selling co-ops can be quite difficult depending on the bylaw of the co-op, but they can also, in some cases, provide more affordable arrangements. So you want to take that into account. Again, we're talking about transaction costs here. If you don't ever need to move, then co-op could be a good option. But if you need to move, a co-op can be a significant barrier to selling a house. We mentioned homeowners association. So what are they, and why do you need to pay attention? So first of all, homeowners association is a legal structure, so which means that you need to pay attention to the bylaws. There is no uniformity in terms of homeowners association bylaws. Each homeowners association can be different. Oftentimes, a single family home in a neighborhood may belong to a homeowners association. And they can govern many things, anything from mowing your lawn to what colors you can paint your home, to when you need to make repair. Before you buy a home, a house that is part of a homeowners association must provide you with the bylaws. So this is one of the questions that you want to ask your real estate agent when you're looking for a home. If they say this is part of an HOA, part of a homeowners association, you may want to ask for a copy of the bylaw. They are long, but they are really important to pay attention to. The reason is that the homeowners association can require you to perform maintenance. For example, you may think that the paint on your house is acceptable, but the homeowners association may decide that that is substandard and you'll have to paint the house. You say, what happens if I don't? Well, if you don't paint the house, then the homeowners association can actually have the house painted and then have the expenses charged to you, and you will still be responsible for paying it. Homeowners association also charge a fee, and they vary greatly. Sometimes they may be a few $100s a month. Sometimes they may be less than $100 a month. The important thing is that find out how much the homeowners association fee is and add it to your budget. Remember, when we do the estimate on how much a house you can afford, we have to take that into account before we figure out our mortgage payment that we can afford. If you purchase a condo, instead of a homeowners association, you have to work with a condominium association. A condominium association is quite similar to an HOA. They are also governed by bylaws. So again, pay close attention to that. What is typically distinguish a condominium from a HOA is that a condominium typically have a lot more common area and common structure. Even if this is a stand-alone condo, meaning the buildings themselves are not connected, condominiums typically still have clubhouses. Some of them may even have swimming pools, tennis courts. All those are considered common structure. Most condos are not standalone, meaning that they are almost like an apartment complex. In that case, the common structure can includes may even include the roof or the outside walls. So all those do not belong to the homeowner but belong to the condominium association. So an important part of that is the condominium association can levy fees to repair these common structures. In fact, those are important and necessary. There are cases in the past where the owner of a condo actually voted down not to repair the structure, and later on severe damages and even loss of life can happen. So you want to be conscious of what maintenance is necessary. And this is one of the disadvantages of buying a home that is part of a HOA or part of a condo, because both homeowners association and condominium association are run by the homeowners. So they are usually subject to a vote, and any changes to the bylaw or changes to maintenance and maintenance are voted in by the homeowners. So if your standard is different from your neighbor's standard, that can sometimes become a point of contention. So you may want to be safer, or you're more conscious about safety, and you want more repair to things such as the elevator or the roof. Your neighbors may not want to take on the expenses. They may vote down the maintenance, and you will not be able to repair that on your own in a condominium. So those are things that you want to take into account when you are deciding the type of house that you want to buy. Now, let's say you have found your perfect dream home, and now you're ready to make the offer. What does that mean? Well, making the offer means that you are trying to buy the house, and the first step is negotiating the price. You can make an offer to buy the house at a price higher or lower than the asking price. And the seller can either accept your offer or reject it, or they may give you a counter offer. So let's say the house is the seller is asking $400,000 for the house, and you make an offer for $390,000. They may come back and say $395,000. That's considered a counter offer. If you make an offer without contingency can be anything. It can be, most of us will have a contingency of getting a mortgage. So the contingency may be I can buy the house if I can get a loan. And in that case, if you have a pre-approved mortgage, that will make that contingency much less significant as a factor. If you have an existing home to sell, then is another contingency. So that again makes an existing homeowner, if you have to sell the house first before you can buy the next house, that can make your offer less favorable. Of course, it's very important to make sure you understand all the terms before signing the offer contract. It's called the purchase agreement. Ask as many questions as necessary before you ask. If you have a single doubt, do not sign that. The reason is because you usually have to make a deposit when you sign the purchase agreement. And it's a fairly significant deposit. It can be anywhere from $5,000 to $10,000. And if you want to back out of the contract, you lose that deposit. So it's very important that you understand the contract clearly before you sign it. Congratulations, your offer is accepted. Now what? Well, the next step is to get a home appraisal. This is a requirement by the bank. So the bank would typically require an appraisal. What that means is they will hire a professional called an appraiser to assess how much the house is worth. So that's the market value. Of course, ideally, you hope that the appraised value is greater than your offer, or at least equal to your offer price. The reason for that is the appraised value will affect the loan that the lender will approve. So, for example, you plan to put down a 10% down payment, and the home appraised much less than what you offer, then you may not have sufficient money to make the down payment and the closing costs, and the loan will not be enough for you to buy the house. So hopefully they will come in higher than or at least equal to your offer price. Once the home appraisal is done, or simultaneously, all these things are happening all at once, you will also perform a home inspection. This may be required by the lender, but most homeowners will also require a home inspection. In many states, the inspectors are licensed. This varies state by state. It's a good idea for you to find someone that is reliable. So what does the home inspection do? A home inspector will identify any potential problems. So for example, they will point out the fact that the furnace is 20 years old and is most likely will need to be repaired soon, or that the roof is 20 years old. So all these things, so they will look for potential problems or dangers such as radon in the basement, or signs of past flooding in the basement. All those are things that they will look for. So particularly pest, radon, mold, because those are harmful to people's health. If the home inspection finds significant problem, severe enough, they may be grounds for canceling the contract. And I know this will be very disappointing for those of you who find your dream home. But remember that home repair can be very expensive, particularly flooding situation, demolding. Those can cost tens and thousands of dollars. Assuming that your home passed the appraisal process and the inspection process, then you're going to do what is called a walkthrough. This is the final step and opportunity for you to identify any problems before you finalize the purchase. So all this will happen after the offer is accepted. Almost congratulations. Now is the big day. This is the day of the closing. So what is the closing? We talk about closing costs. So closing is when the real estate transaction is finalized. Many things happen at the same time at the closing. Real estate transactions are highly governed by a lot of legal requirements. So one of the requirements is that a buyer be given closing cost estimate ahead of time, so there are minimal surprises. So how much do you need to bring to the table? So for example, you need to have down payment. And we talk about ideally you want to have 20%, but less than 20% is possible, especially if you are able to qualify for government subsidized loans. FHA loans and VA loans, they both will enable you to get a down payment of less than 20% without having to carry private mortgage insurance. For those of us that do not qualify for these special programs, and you can only afford a down payment less than 20%, you may have to buy private mortgage insurance, which will be added to your monthly payment. The closing cost estimate that you are given will list all of these costs in details. So what you can expect to see in that estimate will include costs associated with the loan. Typically, there's an application fee, and this you usually already paid when you get the pre-approval. There's also something called an origination fee, and that can be anywhere from 1 to 3% of the mortgage amount. Some loans also involve points. A point is a fee that is charged to reduce your interest rate. So a point is different than origination fee. So those are two different things. Whether or not it is worth paying for the point to get lower interest rate, APR stands for annual percentage rate. So this is interest rate. Depends on how long you plan to stay in the house. And this is we already went through the home appraisal process. So again, this fee sometimes has already been paid. The appraisal fee is to pay to the appraiser for the appraisal of the home, and also the inspection fee. So these are all the fees associated with applying for a loan. The biggest fee of this is the origination fee, and potentially if you have points. In addition to costs associated with loans, even if you buy a house for cash, you still have to pay other legal fees. The most expensive is the title search fee. It can be and title insurance. This is to ensure that the title is correctly transferred from the seller to the buyer, and it can cost anything from $1,000 to upward past $2,000, $3,000. Attorney's fee, it is a good idea to get an attorney to review your document, and those can be, again, $500 to $1,000. Settlements fee, these are required. So again, that varies from city or county to county. And then finally, there are things called escrow. These are not fees, but these are, escrow means prepayment. So you are prepaying homeowners insurance, interest, and property tax. So the most mortgage requires the escrowing, meaning that you put money into a separate account, which is typically part of your mortgage payment that you write in one check in the account, so that when the property tax is due and when the home insurance is due, you have sufficient money to pay for them. And this amount varies, obviously. So understand that this is not an upfront cost, but this is the ongoing expense of property tax, insurance, and interest, but they just require you to prepay it so that it's not a single lump sum when it comes due. So those are the costs to the buyer. Now let's take a look at the cost to the seller. The most expensive cost to the seller is the commission to the real estate broker. That can be anywhere from 4 to 6% of the purchase price. The seller also have to pay title insurance. So notice that title insurance show up in both cases because they want to make sure that the title get transferred properly away from the seller and get registered properly into the buyer's name. They also have to pay attorney's fee to make sure that everything is correct. And they'll also pay the survey's fee. So survey is to make sure to check the exact property lines. So the surveyor will actually come out and put sticks in the ground and show where your property line is relative to your neighbors. Owning a home is definitely an American dream. Unfortunately, the dream is easier for some than for others. Biases in real estate transactions has a long history. In fact, the term redlining originated from real estate discrimination. This term comes from in the 1930s. Banks actually have maps on their wall with different color. And some areas were marked red. These are areas that are considered not worthwhile to give loans out to. And these are lending programs under the New Deal offered by the government. Unfortunately, most of the red-lined districts or the red-lined out areas are black neighborhoods. So even though the lending program was a government program designed to help Americans get in to buy homes, a lot of black Americans were not part of this program. The Fair Housing Act in 1968 specifically prohibits discrimination based on all these characteristics. But even though it's illegal to do it, the practices continues. So today, the term redlining refers to not just black neighborhoods, but personal characteristics-based tactics that bias against home ownerships. So, even though those practices are illegal, research has found that widespread biases and unequal treatment still exist in real estate services. Let's take a look at some of these examples. One tactic is steering. Steering means they would direct a prospective home buyer away or towards a particular neighborhood based on their characteristic. More common, and this actually make some headline news, is bias in home appraiser. In one instance, a home's appraised value increased from $472,000 to $750,000 after a whitewashing experiment. So what they did in this experiment is they replaced all the family pictures with all the black family pictures with white family pictures. And they replaced more black theme decorations and home decors with more traditional white family decors and color schemes. By just whitewashing the home, the value goes up from $472,000 to $750,000. And these appraisals were done by professional appraisers. Another way discrimination happens is in lending. There has been quite a few studies done on lending practices or discriminatory lending practices. One study found that Hispanic and Black homeowners pay significantly higher interest rate. And these are government-sponsored loans, GSE and FHA loans. And they control for risk and other characteristics. And they find that when they control for income, risk, past credit history, credit score, race remains a differentiating factor when it comes to interest rate. They also find that fintech firm, which claims that there is no human interaction, everything is done through software, they still show similar biases. So what can you do as a consumer? Here are some things to watch out for. For real estate agents, if they request loan pre-approval before showing you the listing. Now, remember we said it's a good idea to get pre-approved before you negotiate or put in an offer. But it's different if a realtor says that, let me see your pre-approval before I show you the home. It's a good advice to get a pre-approval, but making it a requirement makes it a red flag. The other is a common sales tactic that if you are pushed to make decision, for example, they may say, oh, I'm showing the house. I know that someone else is coming to see the house this afternoon. You should put in an offer now. That, once again, may be good advice. However, if you're not comfortable with the timeline or if you have questions about the house, this is typically one of the most important and most expensive purchase that an American household makes. So do not get rushed into it. There are a lot of real estate terms that may be new to a first-time home buyer, and you should ask questions, and they should be knowledgeable and patient in explaining those terms to you. After all, that's why you hire a real estate agent, and they are, it's their professionalism and their job to explain those terms to you. If you're working with mortgage lenders, there are many lenders out there, and be careful about something that is too good to be true. For example, if a lender said, oh, we don't require credit check, we don't care about your credit score, that is a huge major red flag. If they make promises that is too good to be true, you should definitely ask again. So if they say, oh, don't worry about your income, don't worry about your W-2, those are major red flags. If they rush you through the process and, again, don't answer your questions, those are not good signs. Some of these are even more obvious. If they ask you to lie so that you qualify for a loan, that is not a good sign. Not answering your question, again, be very careful about those lenders. We mentioned about points. Points is money that you pay to get a lower interest rate. So if you talk to a lender and they say, oh, we can, let's say you get quoted an interest rate of 8%, and they say, oh, we can give you 7.5%. But they didn't tell you that you have to pay points. Remember, points is 1% or 2% of the mortgage amount. So if you take out a $300,000 loan, that's $3,000. So the lower interest rate is not free in this case. So again, when they ask a lower interest rate, the first question you have to ask, now you have the terminology, is, are there any points? So make sure you ask all those questions. Finally, if all real estate documents must be printed. So if you get a verbal quote, always follow it up with saying, send me a paper quote or an email. nowadays. And if the printed document or the written document is different from what they tell you verbally, that can be a human mistake, but definitely something to watch out for. This concludes our module on housing. Good luck, and I'll see you again soon on the next topic.